And Kathryn, I'm just going to kick it over to you first. When you're looking at how we're set to finish up, Dow, S&P, and NASDAQ all up just around 2% as it stands. What's your take on why we're seeing this rally today ahead of the election results tonight?
Kathryn, I think you got to unmute.
I think the markets, Shauna, are internalizing the inevitable additional fiscal stimulus package that's coming regardless of who wins. In the case that it is a blue sweep and the Democrats take control of the Congress and the White House, the difference between their stimulus package and the Republican one is multi-trillions of dollars. So the market really internalizes the fact that what has taken us to current highs, which is the combination of both monetary and fiscal stimuli, is going to continue.
Year-end past this election. I know your year-end S&P price target's 3,500. Right now we're sitting at 3,369. What needs to happen to get us there?
Well, just going back to buy the rumor, sell the fact. What I've been telling our clients, Shauna, is to sell all green energy, have a rally from 100 to 300% year to date, and that is certainly, I think, a place to take gains. What we're telling clients is, look, if the market gives us the opportunity to enter, it is an entry point. That means if we get a correction because there is a blue wave or because it's a contested election, or as I think Brian, one of your guests, said, we don't get that fiscal stimulus package, which I think is not going to happen before year end, and the market does sort of a temper tantrum, then we would be recommending going long U.S. equities. Why? Because the Federal Reserve is there to backstop markets. I think that trend will not change until we have a surge in inflation or until we have a replacement to the dollar in the U.S. Treasury, which is not in the offing. So I think the current trends are going to continue regardless of who wins. If we get that entry point, we must take it. I'm going long industrials and materials, but I'm also counterbalancing that, Shauna, with long positions in inflation-protected instruments. If we do get a Democratic sweep, we should expect accelerated rates of inflation in the coming 18 months. And I think we need to be positioned for that in gold and consumer staples. The possibility of additional lockdowns under a future administration is very real. So be in utilities and staples. And also I like gold positions to act as a barbell strategy, counterbalancing that risk on trade.
Brian, is the excitement among passive, lazy trajectory, is there anything you want to warn me and others like me about that?
Hey, it's worked for you, right? I mean, you could have freaked out in March 23rd and sold everything because the market dropped 35% and missed out on a 55% rally. So I'm not going to tell you that's the wrong thing to do, Adam. I think it's a very good approach to buy and hold, especially you don't need the liquidity in the near term. But what I would say is, to a lot of investors who perhaps haven't looked beyond the U.S. horizon, I think emerging markets is going to have a phenomenal year in 2021. It's one of my strongest conviction trades. The combination of low interest rates in the developed world, negative real interest rates in the United States, a weak and a likely weaker dollar going forward, global economic recovery, and not to mention, I would say most importantly, Adam, is capital flows. We see a lot of big money really interested in returns in the emerging space. I would tell the individual investor to take a look outside of U.S. shores and start accumulating positions in the MSCI Emerging Markets Index and start adding risk, because the fact is the Fed is going to continue to support markets. Anytime it gives us the opportunity, I think we should be accumulating and we should be overweight equities over fixed income.
All right. Kathryn Rooney Vera, Chief Global Market Strategist at Baltic, and Brian Jacobson, a Wells Fargo Asset Management. Great to have you both on the show. We'll talk to you soon.